Hi everyone, this is Rohit Srivastava, the founder of Indiacharts and Strike. Now, while we do mention both of these separately, Indiacharts itself is an app and a content platform, whereas Strike is a product which is a data analytics desktop platform, right? You will eventually get it on your mobile. Indiacharts is, of course, a mobile app. Strike being data intensive and visual about all data, giving you charts of everything that you want to see under the sky, can't completely be put in the same format on a mobile. So it takes some amount of design thinking to really make it possible. And that's something that we will do. Definitely, you need alerts coming your way. You need real-time data. You need everything else working at the mobile level. Coming soon, right? And a lot of other developments there as well. If you have never used Strike, just go to web.strike.money and start your 7-day free trial. So with that, let's get on to the market discussion for today. It is the 26th of August 2024. The Nifty is closed just shy of making another 52-week high. But the bank Nifty is really lagging far, far behind. So that's an interesting pattern that has been going on and on for a while. And I've been saying for some time, interest rate sensitive need to start picking up and showing that momentum. And within that, banking needs to start outperforming. And I say need, I actually mean I expect it to do that. I expect banking and financials, which are an undervalued sector, to actually catch up and start performing in a big way as the rate cycle turns. But it has still not started happening. There are a lot of doubts and question marks around it. So I will spend a little time talking about that. Today, some of the other rate sensitive sectors did pick up. We did see metals doing really well. In fact, metal index has been up for the last 2 weeks and pretty much participated in this rally in the anticipation that the rate cycle is changing globally, and that means commodity prices start to rise. Now, many commodity prices were advancing except for oil and copper. Now we are finally seeing oil again reverse. Actually, oil has made many attempts to reverse and each one has failed. Copper, on the other hand, has been in a downtrend, recently picked up some momentum, was at breakout point till last week from a falling channel after having done an 80% retracement of last year's gains. Today, while I'm recording and I'm speaking, it has broken out of that. At least it's trading outside the breakout point. And if it stays there, we will get a breakout in copper. So do watch out for my post on that tomorrow. So now, once you get that, and remember, aluminium has already broken off out of its falling channel and rallied. We're already seeing zinc do pretty well. So basically, the entire commodity basket has started to respond to the weaker dollar and falling bond yields environment coming from the US. But as far as India is concerned, we are still to see it impact both things. For example, bond yields in India are coming down, but very, very slowly. This is the same problem the US was facing some time back, where US bond yields were not coming down fast enough till certain data showed up of a slowing economy, and then certain data showed up of slowing inflation, and that sort of triggered falling bond yields. Now it's finally reached a point where the Fed is committing to a change in its interest rate policy stance. So that's pretty much what they said this week on the Jackson Hole meeting, that they are going to move on rates. Now it's a question of 25 basis points or 50 basis points or something in between that they will do as a first shot in September. After that, you're going to go into election season. I doubt they'll do anything more till the election results are out. But a direction will have been given. And markets often move in anticipation of all these things, right? Markets have been anticipating this rate cut for quite a while since data changed, and only became more and more certain of it, I think, in the last meeting as he finally started to speak of the Shom rule. A lot of people said finally he's changing stance because he's beginning to pay attention to weakening employment data, even though there are people out there who believe that the employment data itself has data issues, right? Because a lot of the unemployment comes from things like immigrants and who are showing up as unemployed. And so apart from data issues, if he just had to follow the data, he found himself enough reasons to say, okay, fine, we should lower rates. And I'm not able to get the part as far as India is concerned. So in India, bond yields are falling, but the currency, USD INR, despite a very, very weak dollar, is not really coming down. Now, when you're in an environment where interest rates are weakening, that is, bond yields are coming down, the currency can weaken, right? So in that sense, it makes sense to see that, okay, the USD INR is weakening. But is that the real reason? I mean, we aren't really getting portfolio flows, which have been the main contributor to and supportive of the Indian economic activity, right? In the entire previous business cycle, 2003 to 2008, FII flows were very, very strong. And that sort of helps when demand is growing and you need to import a lot of goods and services. Then the flow of foreign institutional money really helps in providing that balancing effect as far as the trade balance or current account balance is really concerned. And that has been really missing, this time around, at least from the institutional investment into equity. They have been investing into Indian debt, but equity flows have actually been very, very muted. It does come in for a while, but very quickly changes to the negative side. That is a very, very new phenomenon. Earlier, it used to be flows all the time. A lot of this has changed since we started to change tax laws for foreign institutional investors, where a withholding tax really came up from what used to be a no tax region, and then we started to even attack the Mauritius route and so on. And I think that sort of be the reason, though some of the media interviews with those who actually give support the foreign institutional investors, because they are their clients, have actually been coming in media and saying, oh yeah, their concerns around valuations. But valuations alone, I don't think can be the concern area. Anyway, I'll come back to that topic. But what I want to really talk about is interest rate policy first, because that directly impacts the banking sector. That is where I started this conversation. And there's a lot of back and forth. I mean, RBI is saying we don't really want to move on this. We should be careful. Bond yields are falling. They're leading the way, just like they were doing in the US. And the Fed also there was saying the same thing till eventually they gave in. So I'm really wondering, what is the point at which the RBI will give in? Will they give in after yields have fallen sufficiently? Or will they give in for some other reason? I mean, just under pressure. Or will they give in to the bond market? So I'm not really sure what is it going to be the trigger, because they're not coming out very, very clearly on this. The US at least was out with certain data points that they're watching on inflation, on employment, that could be drivers of their policy. The RBI mostly talks about the inflation rate. They don't so much talk about employment. But during the election season, there was a lot of talk around unemployment. And that is one of the areas that should concern the RBI if they have to think about it in the very, very same way. The other one was a lot of narrative that moved around, in this market, which some of which has to do with the banking sector, because that's what I'm trying to point to. If rates actually can go down, does it help the banking stocks? And some of the pushback that I get with people I speak in banking is that, well, we do need to get deposits in, and how does that work if we really cut rates? So that's a very interesting perspective. As it is, money is moving out of equities into the stock market, which is pushing the credit deposit ratio in a particular direction. Now, some of this might have to also do with the credit growth coming off a bit during election season, because credit growth, when I actually look at growth numbers, credit growth has not been so bad. Credit growth in India has been pretty good if I actually look at raw numbers. And therefore, even deposit growth is not so bad. So it's really not about whether this is bad or that is bad. It's a ratio. So we're really getting concerned about a ratio that, if this ratio has gone up, it means that, there's no money in the bank. It's not like there's no money in the bank. It's just that there's a ratio. Which ratio is good and which ratio is bad? How much should your credit to deposit ratio be in a good bank? Can somebody tell me that? I would like to know. I haven't spent time thinking about that. Everybody just writes about the ratio rising or falling. It's gone up a lot. It's at like a 6-year high or whatever. And that means it must be a bad thing. Now, I wonder whether a lot of this had to do with narrative building, because we were going post-elections into the budget. And two things we started to hear and talk about. One is too much money going into the stock market from banks, so bad for banks. And then all this money is going into the stock market and they're trading derivatives. So bad derivatives are ruining the retail investors because they're losing money in derivatives. And so all this had to mean something. You have to take some action to change this. And the only action we got is, let's raise taxes on investors. Now, I really wonder whether this narrative building was just to raise tax. Because like I said, on the one side, the credit deposit ratio, what ratio is good or bad? I mean, both are growing. Deposits are growing at X%, credit is growing at Y%. The growth rates are different, and therefore when the growth rates vary or the difference between the growth rates increases, then you sort of got the credit deposit ratio going up, right? So it had gone up to a significant high in May and June, and then it's come down from some 90 percent down to some 80 or 0.8 or whatever that number is. And the point is that too high? Should it go back to a 0.7, 0.6? So what is good and what is bad? So that's the main point we're trying to understand. Yes, credit growing too much more than deposits. And then what's wrong with credit growth? I mean, that's the driver of economic activity. And that is why we have 7% GDP growth, which I think is baseline, because that's what we achieved in the GFC. The year that we had the great financial crisis and the stock market crashed 70%, we still had GDP growth at 7%. So that's like, it's called like India's growth cannot go below 5, given the way we have a large public sector in the economy, and then you have government spending and so on. And government spending has increased in the recent years in the post-COVID period, not just in India, in the US. So you have a new source of growth, kicking in, which was missing, at least in many places. US, it was definitely missing for a long time. And so you're trying to stimulate growth through government participation till the private sector jumps in. The private sector is, sort of getting over its last debt cycle. And that is why they're taking time. But animal spirits eventually kick in. Now, animal spirits are kicking in to some degree. That is why you have credit growth. The only thing is, can you have higher growth? So that is my bigger concern, is not whether the ratio went up. My concern is, why can't I have more growth? Why can't I get more credit off the table? And for that, you are going to need lower rates, because if you need capex to happen and you want government capex spending to come off a bit and private sector capex participation to increase, you're going to need lower interest rates. So how do you get that going is the bigger question, not whether it can happen or can't, or whether this is right or this is wrong. So like I said, in the end, it will sound more like a narrative building for raising taxes, which is over, done with. Now the question is, what next? Now, if you really had a problem with options trading and weekly options, the measures that SEBI is planning to take should actually be taken, right? Go to one settlement a week. At least that's one step forward. We've gone completely backward on this, daily, every day, some index is expiring and it's not even liquid. And everybody's trading that, and the room for manipulation there is very high. In fact, I even feel Bank Nifty with only 12 stocks should not even be permitted for options trading or futures trading. I know Bank Nifty was once upon a time one of the biggest attractions for weekly options and so on. But the whole point is, it's a highly biased index. When you have only 12 stocks inside it and one stock or two stocks can move the entire index, then you might as well just trade the options of that particular stock. Why did you create an index to trade? You'd rather go with a BSE Bank Index, which has like 100 stocks in it. And now you have an NSE Nifty Financial Services Index, which is a little more wider in scope and can be less manipulative. So coming back to the point, yes, SEBI should take some measures on that front that will at least take care of one problem. But is the banking sector problem a problem? So I think that remains an unresolved thought and process. I think the real thing you want there is growth to pick up, right? And in any case, because credit growth is happening, as I said right at the beginning, earnings growth in the financial space has actually been good. Banks have actually been growing, whether it's 15%, 20%, 25%, different banks at different rates have been growing earnings. NBFCs have been growing earnings, even though the stocks have not been performing on a price basis. And what that has led to is that some of the stocks now at -1 to -2 standard deviations on their valuation charts, which you can check on Strike. Strike has the entire historical valuation charts of all the stocks. And we are at like a 10-year low on valuations on some of these stocks. So it is a cheap sector. It is an attractive sector in terms of valuation. It also has growth. So it has both of those. The only thing which is not happening is it's not gaining attraction. And one of the reasons we've been hearing for the last 3-4 years has been that excessive ownership by foreign investors. And therefore now when FIAs are selling more often than buying, they end up selling banking because that's where they owned a very, very large stake. So that's something I've heard repeatedly over the last several years. And that logic makes a little more sense than the other logics. But the point is, how do we really get these foreign investors back? There have been some news items today in the papers about, making it easy to transition as an FIA to FDI in terms of investment. If you're a single FIA investing significantly in a company, can it be considered as FDI? And can that transition? Earlier, it was like, if it has to be FDI, you have to first, exit your institution, your portfolio holding, and then become a investor, and that can be painful because you have to sell and then buy, and there's a transaction cost, there's an impact cost, and they're going to make that smooth. You can just change how you mark a particular asset. But will that be the complete solution? There'll have to be something on taxes as well to make it actually easier and attractive for foreign investors. Though I really wonder, is tax really a reason to invest? Because when global investors are moving out, they often look for this reason. They look for tax havens. But when they're investing in their own country, and if you read any book on investing, and this is something that even I say, tax is never a reason to invest or to sell, because you're basically chasing returns. So if your returns are high, you pay tax, right? You pay an X tax, and post-tax returns should be good. So that is definitely happening in India because return rates are pretty high. But what may further hurt foreign investors and what may at least appear as an attentive risk is foreign currency risk, right? Even in an environment where the dollar is falling, the USD INR is weakening. Now, it may not be falling by 7% per annum like earlier, but all the same, when you perceive currency risk, that is an additional cost if you want to hedge it. And then there's tax, right? So you have two things now instead of one to really hedge against your return. So even if you make a 25% return, you pay a 15% tax or even 10% tax. Okay, so there goes out of 15% a bit. And then you pay currency hedging costs, which can actually be higher. And your 25% return will actually come down. Now, it might still be attractive, is what I would like to say. But like I said, a lot of investors do consider tax at least as one of the reasons to enter or not enter a country. So that's something to think about. What else could be bothering them? So, well, I feel that a lot of negativity is built towards this sector, which is why banking has lagged. But my chart setup on banking says that banking is broken out post the elections, and it's going to outperform in the weeks and months to come. Will it eventually lead to the foreigners buying back the bank holdings that they've sold? Let's see. That could be a positive. I feel somewhere no economy can really grow and charge up and grow even faster if you don't have banking growth, right? Banking is a sector that has to be part of the economy. So that's that as far as banking is concerned. So a lot of communication happened, I think, around the election season to create public consensus around taxing, around different belief systems. And investors have started to believe that there's a banking systematic risk. So this is the other problem. And I faced this in my Twitter spaces, questions around whether banking in India is at risk. They don't have deposits coming in. There must be something wrong. Every time RBI keeps coming up with some issue in the banks, there must be something fishy going on. Maybe one of these NBFCs is going to default. And so this thinking is being built in because of this communication that the government has actually done around derivatives and banking has created a sense of fear around the sector among investors. Now, this could be another thing impacting the sentiment around banking stocks. Otherwise, so many stocks and sectors have performed well with the domestic investor flows. Why can't banking also do that? I mean, whatever foreigners had to sell, they may have sold, right? Or there should be enough buying to balance it out on the other side. So many other stocks and sectors have done well. So that can't be like, you can't blame the same reason again and again every time. So there has to be something else, and it's got to do with some kind of sentiment against the financial sector that also needs to resolve, and it involves a lot of negative communication. I think that is really happening around there. So are equity markets really in a bubble? So that's the next final thing that we come to with all of these narratives building around. And equity markets, what is a bubble? We really need to define what bubbles are. A lot of the bubble talk actually comes from the risk around valuations, right? Like I said, FII's communication, they're not coming in because of valuations. Domestic fund managers, many of them are in interviews on television talking about valuation risk. Some of them have moved on and started to diversify, so they've gotten fully invested or changed their sector allocations towards a more defensive stance, which means pharma, FMCG, IT versus other growth sectors where they felt that maybe valuation corrections are possible. So these kind of systematic shifts have been done, but still the cash held by mutual funds, that ratio has actually gone up in this period because of these perceived risks. I guess that a lot of the equity flows that are happening every month through SIPs and otherwise are being held as cash on the books and not really being deployed at the pace that they were being or would have been otherwise. So that's one way that the cash level will keep rising. So even though domestic investors are not selling, they are buying. But at some point of time, it's the market momentum itself that will drive both FIs and DIs to be significant buyers of this market on the way up. So that is how bubbles start. It's not the end point. The starting point is that money that's on the sidelines gets deployed and it drives the rally, and then more money comes in. Bubbles really get created not by valuations. There's a lot that has been said about this. No bubble has been, no major market top occurred because valuations have been reached. It usually has to do with something else. Bubbles have to do with excessive leverage, like you had Y2K. Was it a tech bubble? Were valuations high? Yes, but there was excessive leverage in terms of borrowing. I mean, I can give you examples of India. I don't know how it was in the US. We can say margin debt levels in the US were very high, but as a percentage, I don't know. I mean, I'll have to delve deeper into US data, available data, and see how you can justify that. But I can tell you in terms of numbers, the Badla system in India had almost 12 to 15,000 crores of outstanding weekly rollovers happening, okay, in terms of positioning. Now, that was more like a futures market, which was sort of built into the existing cash market rather than you have a separate FNO and cash market. We used to run it in the same market. All buying, selling used to happen on the same exchange. And then the segregation was done. End of the day, you had to tell your broker that what I've bought is for Badla, and then it would be marked, and you had to roll it over by paying some interest cost on a weekly basis. That was how the system worked. Now that happened, and then NSE, which was feeling left out, came up with something known as ALBM, right? The alternative lending and borrowing mechanism. And NSE also had a different settlement, which I'll come to. So while we think, okay, 15,000 crores, not much. Now add NSE comes up with ALBM and builds up another 15-20,000 crores of outstanding, which is being rolled over. The next thing is what we can't count. So this is already 20-30,000 crores, okay, or 35,000 crores of net risk in the market through margin debt. But now there's a hidden margin debt, which nobody talks about even till today. I haven't heard anybody write extensively about. So I should tell you, and I repeat this many times. And this is the NSE implementing a differential settlement just because of competition, right? Many times people do competition and the net result of that ends up being something else. I think this weekly options craze also is partly like that. I mean, BSE was out of this race. They started a Friday settlement for the Sensex. Next, you have NSE implementing, every day some index closing and some index trading, trying to overtake the BSE. And now what do you have? You have SEBI stepping in and saying, hey, sab log pagal ho gaya, people are losing money, stop this. So that's how it ends up. And the same thing happened then. NSE started a weekly settlement from Tuesday to Wednesday. BSE was Monday to Friday. So what did the smart people do? The smart people said, well, let's buy on NSE on Wednesday. And then when it comes to Tuesday, let's just roll it over to BSE. So we don't have to pay any margin. So if you had to pay a margin to buy something on the Badla system, 10%, 15%, 20%, and hold on to the stock. Now say I don't have any margin and I don't have margin money. I just buy stock. And because it's a bull market, stocks are going up. So I get mark to market and I don't have to pay for any loss because I'm in profit. So I just hold on to the position and roll it. But if I roll it on the same exchange, I will end up paying margin on a Friday or on a Tuesday, depending on the exchange I'm on. So I don't do that. I instead say, okay, let me just shift the position from NSE to BSE and then from BSE back to NSE on Friday. When the BSE settlement is ending and I don't want to pay margin, I shift it back. So if I keep doing this, I could have huge amounts of position shifting from NSE to BSE and BSE to NSE every week. Nice, right? Now you will say, no, that didn't happen. That's not possible. The answer is it did happen, and it happened in very large quantities. A lot of operators and a lot of traders who were in the market with large positions were also doing it because it was a free ride, right? It was a free ride to the top. And it also meant that there was arbitrage. See, that is the best way to know that this thing was real, whatever I'm saying. The arbitrage between NSE and BSE was running at 50% per annum. Few people understand that. At that point, I told my brother, boss, I'm working with this company and we're doing weekly arbitrage at 52%. He's like, he was studying MBA in the University of Berkeley. And according to his professor, there's no such thing as arbitrage. Even if it showed up, the arbitrageurs would remove it and make it go to zero. What that essentially means, it would come down to closer to the rate of interest. And that means it would be negligible. Or maybe slightly higher than the rate of interest, which is how a lot of arbitrage in India has sort of become today, though a lot of arbitrage desks do generate a slightly higher return than you would get in a fixed deposit, but you have to pay tax on it. So end, it comes down to a narrow edge on returns. But this is what was happening. You're getting 52% per annum. You can just imagine that means it's like 1% per week. So you could actually roll over your position from one exchange to the other. You were paying 1% per week because the returns were very high, right? Every week when tech stocks would rally, they would go upper circuit, upper circuit, upper circuit. And the minimum upper circuit was 4%. And sometimes after a waiting period of half an hour, it would be opened and then it would be 8%. And so these kind of wild moves, why wouldn't you pay 1% to roll from one exchange to the other when you're in a bull market? So people didn't mind and they were doing it. And desks like ours, the one I was at back then, not with Sherkhan, I was with another company, was essentially taking advantage of this shifting by doing arbitrage, right? So instead, we would be buying on NSE and selling on BSE and earning that 1%, every week between the exchanges. So you buy delivery here, sell it there, and then buy it back after a few days. When you have to settle it, you again reverse the position and you were making an easy 1% every week over and over and over again, as long as there were people willing to borrow and roll over for free. So that's what was happening. It's a crazy system. There's no measure of how much was really being moved between the exchanges. And I'm sure it was a much larger amount than the Badla system. So if anyone double the entire 30,000, I can say 60,000 crores of margin debt in India was really rolling from exchange to exchange. And that's the amount of leverage that was sitting in the system, apart from whatever stocks people bought as delivery. So that was the tech bubble. So that excessive leverage, when it started to unwind, led to huge losses. A lot of the companies which were not so great lost 60-80% of their values. I mean, imagine even a company which we all know, Z, like Great Network, has a lot of television programming, got involved in that indirectly, and the stock went up. A lot of operator buying. We used to see 1 million, I think 100 million worth of volume a day at one point of time. And because there was so much leverage in it, when it unwound, stock went from 1,000, close to 1,000 to almost 100, sub 100. I saw it go down to 60 or 50, I think, at one point of time. Significant decline happens when the leverage unwinds. And all this happened between, the most significant decline occurred after March 2001 into June, July. And then by that time, by June, Badla system had been banned, put out of existence. So that was how the entire unwind happened. That all these systems were closed and people had to close their positions, weekly settlements done away with. And then we moved towards FNO with a T+2 or something like that. And the world has changed since then. So the fact is, there's always leverage, whether it's Harshad Mehta bubble, whether it's US margin debt, 2008 US housing bubble. So these are always created by a huge leverage or systematic risk somewhere that really causes the bubble to end. And this happens during the bull market. Valuations do go high. There's no doubt about that. But then something in the system, somewhere people go overboard, and that causes the bubble to pop and the unwind. Are we there yet? It's guesswork, right? We have to, like right now, we can say valuations are high, but are the other systematic risks visible? At least if I speak to most brokers, they feel no, there's no margin debt, because so many risk measures that have been taken by the exchanges. SEBI has implemented measures. Most brokers that used to give margin funding now usually tie up with NBFCs. They provide the funding. People go to banks and borrow if they really want, some loan against shares. So a lot of different mechanisms are there. And maybe they're not abused to the same extent, though everybody must be borrowing to some extent from banking. Better holding periods, higher margins on intraday trades. So the amount of leverage intraday traders were taking has also been reduced. So daily volatility has come down. So much has happened, So all the measures that SEBI has taken on cash funding and how brokers were really allowing people to even trade short term has sort of reduced that risk to a certain extent. So somewhere something will develop at some point of time, as it always does, sure. But I'm not sure whether it's there right now. And then that takes us back, therefore, that if you have high valuations, are you in an environment of high growth? Because high growth always justifies high valuation. So if we say valuations are high, but we do not talk about growth, then it's the half argument. One of the first investment books that I read gave an example of Tata Power having a P ratio of 40 and then Tata Power having a P ratio of 5 at two different occasions in the 1980s. So I'm talking about a book I read in 91, 92. And what that showed is that when you bought it at a valuation even 40 times, the market was anticipating growth and that therefore charging you a premium. He's saying 5 years later, the stock was up multiple times. Okay, so the high P ratio gave you growth and you did make money. At the same time, when you buy a low P stock and you're really buying low valuations, which is negative sentiment when people are pessimistic about the company, then also if the business cycle changes and you go from low P to high P, you also get a high rate of return on your investment. So both type of things happen, and therefore this judgment around whether valuations are high or low, very important with relation to growth. Is growth really high or low? Is it going to continue? Is growth going to slam to a halt next year? Then definitely it is a problem, because when you look at Y2K, Infosys, for example, was growing earnings at 100% at once upon a time, and P ratios went to over 150. Then earnings growth starts to slow, right? It goes to 50%, then 25%, and then it eventually comes down to single digits at one point of time in the next 15 years. So it takes a long time for you to go back to those levels and those P ratios, right? You don't go back to those P ratios, in fact. So stock comes down a lot, then it starts to rise, eventually takes past the all-time high after 10 years, because the high P and slowing growth rates eventually meant that what you had paid for at the peak was not achieved, right? Because that was 100% earnings growth, which was no more possible. So when you can make a forecast around growth rates coming down, then you can actually say a P derating, or the chances that your return will actually decline significantly from there on. And it will take a very, very long time for you to really earn a positive return if you have overpaid for growth and growth is slowing down. So having a judgment on growth is also particularly important at this point of time. Otherwise, we can end up seeing the market is overvalued and still miss out on the next 20 bagger, right? So knowing the internals, what is happening in the company, is it really growing? Is it in the right sector? Has it done the right things to really grow at the rate that the market is anticipating? That's an important insight when you say something is overvalued. So I think in today's market, we have a fracture. I'm sure there are stocks which are overvalued and not growing. We saw that for a long time in chemical stocks. It can happen in other places, but there are many places where growth is happening as valuations are high. Unfortunately, those valuations are going even higher and higher. So surely there is a case somewhere for things to consolidate. But will it happen now? Will it happen later? Or will it only happen when the bubble pops? History shows it only happens when the bubble pops. If you're growing and you have high valuations remain sticky at the higher end or even continue to expand. And at the same time, if you perceive risk, there are places where valuations are low. It was true in pharma, it is true in banking, it is true in many other individual stocks if you look around in the key sectors and outside of them, including in mid caps. And so it really comes down to your ability to search. If you're in a bull market, if liquidity is expanding, if interest rates are going to go down, the dollar is falling, good for emerging markets, all that narrative is here and favorable, and you're holding yourself back from the investment environment because you fear something else. I mean, the only thing I feared last 6 months was rising rates in the US. If that broke something, then yes, it would slow everything down. But moment bond yields started to decline, I gave up my bearish case. And so that is the macro, right? At the macro level, you have done away with macro risk. Now you have to deal with micro risk. So we are talking about, will the company grow? Is the valuations good or not? Do the valuations support growth? So now this is micro. So now we are actually going into the nitty-gritty of bottom-up analysis and choosing the right stocks, choosing the right sectors, participating in a positive macro environment for positive rates of return till the point where a real bubble really develops and pops. Doesn't look like we are at that point right now. So that is the main thing to take away from here. And if you don't have over ownership in a particular asset, or you don't have excessive leverage somewhere, this gravy train will continue to go because the macro has actually shifted favorable. We may see some hiccups, usually closer to the US elections. There's usually a hiccup in the global US market, which can put some pressure on other markets at some point of time. But as we are looking today, Indian markets broke out of, last week they were above the 20-day average. Now they have closer to the upper band, closer to the all-time high. Like I said, financials, I think, need to pick up. Banking is not even at 61% retracement of the fall, which may be closer to 51,000 something, if I'm not wrong, 51,300 or something. I don't remember the exact number, but we need to go up there and get past that. And so I think banking will continue to pick up and take charge. And as it does so, will continue to contribute to further upside in Nifty, apart from many other sectors, including interest rate sensitive sectors, which include metals, autos, apart from banking, realty, that tend to do well in an environment where rates are coming down and it becomes easier to borrow, spend, or buy and make those purchases. The other thing I've been highlighting, if you saw some of my recent videos, is a sudden outperformance, or rather it's been there, but it's showing up in the top performer list, is consumer durable stocks, right? That is a sector which is gaining attention, gaining traction. I've really not looked at valuations, but I'm looking at momentum. The relative strength is right now favorable to that sector. And even today, it was among the top gainers in the morning. So one more interesting place for you to look at. So that's all in this update. I think I've sort of highlighted why I think the market remains bullish despite so many factors roaming about. Not all narratives are accurate, and some of them are around fears that are in a maybe, maybe not zone. Markets should correct, but should is not an argument. They do sometimes when something goes wrong. Some of the things that could go wrong are now behind us, and therefore you really have to find a new reason for the markets to fall. The reasons that can drive it further ahead, well, the election phase is over. The government spending for the rest of the 9 months, they have to complete whatever expenditure plans they have. A lot of new measures being taken every day to stimulate certain sectors or investment in the direction as designed by the budget. So actually focus on what they are talking about, whether it's MSMEs, whether it's renewable energy. All of those spaces can actually end up being places where you actually find new opportunities. So focus on what the budget tells us, and but stay invested. That is my thought. Till new risks show up, I think there is a good trade, and at the same time, it's a time to stay invested and continue to ride the gains as long as this cycle lasts.